Hello, everybody. This is Shecky, and I am here with my amazing partner, Mr. Jack Gibson. Hello, Jack.
Hey, Shecky. Hey, everybody. Welcome to the podcast today.
Yeah, we've got something really, really exciting today. The title of today's podcast is called Predicting the Unpredictable, Investing During a Trump Presidency. So I know everybody hates getting political, but we're going to just have to go down this road today. So we're really, really glad that you're here.
Well, I don't think we're going to get too political here today, Shecky. We're really not taking sides on this particular, administration. It's more of like, how is the administration going to actually affect you guys as investors?
Understood. Absolutely. So here we go. Welcome to the High Return Real Estate Show, the podcast for heavy hitters. 2 men, 1 mission. It's time to build your empire. Okay, everybody, we are back. Welcome to Predicting the Unpredictable, Investing During a Trump Presidency. So look, we all know that Trump is unpredictable. Doesn't matter which side of the fence you're on. Today we're going to talk about how do we predict what will happen, especially within the environment of investors. What are the things that affect investors? So we're going to get into some of the stuff that you've been hearing in the news, like the Federal Reserve and the recent rate hike, right? Trump's delay of Obama's Fiduciary Rule and some of his deregulation intentions. We obviously got very tired of the saying draining the swamp over the whole election campaign, but we're going to talk about how that's really played out and really who is responsible for all this mess and what kind of storm is coming and how would we want to survive that storm. So this is just a jam-packed show. We're really glad that you're here with us today. And so, Jack, tell me a little bit about it. Like, how do you think we predict someone so unpredictable?
Well, that's the $1 million question, Shecky. I don't know if there's really any answer to that. We look at all the politicians in the past. How many of them actually live up to their campaign promises? We could count them on one hand and don't need too many fingers to do it, right? So, yeah. Trump is, he's a businessman. He's not a politician, and he's not used to working in a bipartisan environment where, not everybody's going to be a yes man on his, so-called team. So as a result, he's used to taking big risks, pushing his way through, creating, really massively big successes. And also, as we can see in his track record, he has some big failures as well. So this is going to be a really interesting test of the checks and balances built into the American political system. And so we don't really know what's going to happen. And so we, as investors, we need to put ourselves in a position so that we can thrive no matter what happens with this administration and with this economy.
So don't you think, let me just ask you a question. Don't you think, it probably could be said that from a personality standpoint, the man that sits in the White House right now is a bit of a bully. And when you deal with a bully, doesn't that create a situation where you have just sort of bigger swings and outcomes? I know you use the word bigger failures and bigger successes, but don't you think that, again, I'm not like you, I'm not playing side, but don't you feel that creates for more volatility?
Well, of course. We can certainly, it's the really difficult thing here, Shecky, is to kind of like predict the future of Trump in a, political setting based on the past, the way he's shown up as a businessman. Will he be, the same? Will he be that bully, or is he going to, tame down and start to, kind of fit into the whole political landscape? I think that either way, whatever happens, there's certain level of volatility that we're going to see. Now, how massive it's going to be, I guess only time is going to tell.
Yeah, it's definitely going to be a wild ride. I think this is one of these ones I kind of want to be somewhat strapped in.
Right. Absolutely.
Yeah. So let's talk about the Federal Reserve and the recent rate hike. I know you've got some thoughts on that.
Well, I mean, if you're borrowing money to buy real estate, which, a lot of us do, I mean, that's certainly very common, right? As real estate investors, we want to leverage our money and use other people's money, use bank money to be able to, create a higher return. And I'm all for it. There's nothing wrong with that in any stretch. But, when you look to do that and the Federal Reserve is increasing the rates, well, your costs of doing business just went up. So you're going to really need to be careful about what you're buying right now, as soon as, as rates continue to climb and now and into the future. You're going to need to have a bigger spread on, the money that you're borrowing compared to what that property is actually pulling in cash flow. So the bigger the rates get, the higher the rates go, just increases your level of risk. If you're a pure cash investor, which certainly nothing wrong with that, especially in today's volatility, you're not gonna have any issues. It doesn't matter to you where the rates go, or if they go up or if they go down. You really don't care, right? All you care about is what is your return on your cash flow or your cash that's invested. What is your cash flow ROI? So, short-term cash checking is going to be more expensive. Talk to us a little bit about the savings returns. What's happening there?
Well, it's, if we look at just, standard people holding cash right now, against the rate hikes and against the other borrowing, there's actually a bigger gap than what there was just a few months ago. So we're seeing a situation where savings returns are not keeping up with inflation. And, like you say, unless you are, leveraging some good inexpensive cash, or you're completely a cash buyer for things like real estate that are producing passive income, then it's not really doing you any good being too liquid right now in cash. It's actually hurting you. You're not keeping up with inflation. So it makes sense right now to look for good places to park your cash, and especially knowing that there's more rate hikes coming.
Sure. The artificial, stimulus that the government has put in and the Fed has, put into the economy by keeping the rates really low has really hurt the savers. So now the savers are going to be forced into investments that, could be definitely considered more risky. If you're in the late stages of life, I don't want to, when I'm, get to be that retirement age, I don't really want to be into, risky bonds and high, yielding stocks. I want to be in safe income producing investments, right?
Yeah.
So, but the savers just don't really have that option because they just don't get any return on their cash. So they have to figure out a way to deploy that cash safely and at the same time be able to get a return that outpaces inflation. We believe we have an answer to that dilemma, but it is nevertheless, it is, I'm sure, a very stressful dilemma.
Yeah, for sure. Then we have this whole issue. The other big thing that's been in the news is the whole delay of Obama's Fiduciary Rule. And I know that, the Obama administration had, I think, some really, really good intentions when that was put into play. And there was a lot of topsy-turviness in, 08 and 09. I'm saying it mildly, but that was the intent, was to really smooth some of that out so we wouldn't see some of those same problems again. But talk to us a little bit about that, Jack. Like, what's your take on this whole delay of the Fiduciary Rule?
Well, I think it's, I think the intent is good, but it's, very, very complex as far as the level to which the financial services companies are, working to comply. I think ultimately at the end of the day, Shecky, the big thing is this is turning to more of a fee-based advice. The question is this less incentive for advisors to do a good job, or is there more? And there's lots of controversy about this one. I certainly don't have the answer. We look at things like regulation. Anytime there's less regulation, well, there tends to be a little bit more craziness. Like 2008, you have more regulation. You can tend to create higher fees. So what's going to happen from this, Shecky? I think anybody's guess. It's just going to create more and more, uncertainty.
Yeah, it's an interesting situation because I think that if you look at let's just look at somebody that advises someone else on investments, right? If they get paid on a fee-based, a flat fee, then that's sort of the idea here, is that they're supposedly acting in their client's best interests, right? So let's say that we have a situation where this rule goes into place, into full effect, and like you say, the financial services companies then have to, and they're already trying to, scramble to comply with the whole multitude of layers of legislation that's been put into this, right? That always equals higher fees. So even with the best of intent, that's going to mean that your flat fee that's going to your financial advisor is going to be higher, even though he or she may be acting supposedly in your best interests. And as a result, your cost of getting that advice just went up, right? So that's one side. The flip side is deregulation. So we know that Trump has an intent to have some deregulation, and there's a lot of people that don't want this rule dismantled, right? And let's say hypothetically it becomes mostly dismantled from what its original intent, and we go back to that sort of wilder ride than we had in 08 or 09, then we have the financial advisors basically acting completely in the best interest of themselves, right? Like it's, we might have more risk, but when we go to make investments, we also might see more rewards as a result of those risks, but the risks are inherently higher. And as a result, who knows what the costs might be, right? It's just, it's almost predictable we'll have higher costs and fee-based, but it's completely unpredictable if we go the other way. So, and I don't necessarily have an opinion on it either. Honestly, I'm a bit frightened both ways. Right. I think that it's extremely controversial, and it's obviously something we're keeping a very, very close watch on. But it's going to be really interesting to see what happens. So anyway, I don't know what's going to happen. I mean, clearly we're not political experts here. I mean, you and I are real estate investors, just like all of our listeners, right? So, we watch some of this stuff and we keep an eye on it, but it's, just the fact that we've got somebody so unique with such different stats sitting at the helm really is, interesting is not really a strong enough word for it, right? Right. So anyway, but look, we're not political experts, but it's clear that Trump's intention to drain the swamp, to use that term, he's done some of this well, and he's done some of this really, really poorly. It's, some of it are, like you read some things about, being able to reduce some of the big agencies that we have and not create such a big drain on the government. That would be fantastic, right? But then you read other stuff about just these huge, corporate industries that are, destructors of the environment going out, and, these are people that are now, just in positions of really, really influential positions that probably should not be there, right? So there's been good and bad on both sides, and clearly there has to be a balance between deregulation and stability, right? Unfortunately, that balance is very, very delicate. It's very, very precarious. And I think it's difficult to have a situation where you have a personality, and I'm not saying it's all Trump, because obviously there's a lot of other players here in this whole charade, as it were. But when you have such a delicate balance and you have the man at the helm with a personality that's very much like a bull in a china shop, it's very hard to understand the delicateness, right? And it makes it, I think, more difficult to achieve that delicate balance, right? So it's very, very clear that we're in for a wild ride.
Right.
And the thing that I find probably the most disconcerting, and I know you and I have talked about this before. I mean, I'm not much of a TV watcher, and I'm not much of a news junkie or anything like that, but the mainstream media is not helping. I mean, it's obscene what's going on with the mainstream media. It's like mocking the president, mocking anybody political has truly become a national sport, right? I mean, it's just sort of what they do. And, the left and the right, which basically there's really no media in the middle. It's really just, a left non-objective media and a right non-objective media. They're completely polarized, right? And people will believe what they want to believe and then just sort of gravitate and read towards that side of the agenda that they gravitate to, and that further supports their argument. And this polarization that's gone on and the finger pointing just creates a more unstable environment. It just adds to this instability. And I look at it and I go like, well, gosh, like mainstream media essentially to me, and I'm kind of reducing this to a common denominator, but I see them as basically just in the business of blaming. And that's a tough thing, so it's just, again, it's not all Trump, and it's not all the other, good and bad politicians that are out there, but, the system itself has really got some big issues, right? And you look at the MSM, who they're blaming, and kind of the question that I have for you, Jack, is, with this whole American system in uproar, like who's really responsible? Like, who's going to fix this?
Well, I think I take on the philosophy in my life that I'm responsible for 100% of what happens to me. So I don't blame anybody or look for anything else other than myself. So, that's certainly philosophy that served me very well in life, and I know a lot of our listeners as well, is that you take 100% full, complete responsibility for everything that happens to you, good and bad, in your life, and then you have to put yourself in the driver's seat. You're the one in control. You're the one that has the power. When anytime you start relinquishing that and blaming others for anything that's happened to you, then you have given away control and also therefore the power to direct and make the situation either great or not. So
yeah,
I think it's really what this really comes down to is that, all of us just need to do our best to make the right decisions for our own personal economy. And at the end of the day, that's the best that we can really hope to do.
Yeah,
so,
I wholeheartedly agree. And honestly, I got to tell you, Jack, I would be clapping right now if it wasn't going to mess up the recording of the microphone in front of me, but it's like, I think that, the whole issue with, and I know I went on a bit of a rant with mainstream media, is like, they set up a situation where they expect someone that you'll never meet living in a big white house in Washington, D.C. to fix things for you, right? And we get kind of lulled into that. So I so appreciate what you said, and the way that you said that is that, we're all responsible. We're 100% responsible for our own lives. And the moment you give that away, And the moment you say it's somebody else's fault or it's the Fed's fault or whatever, it's like, hey, look, we know savings are not keeping up with the Fed hikes, right? We know this, right? We know that CEOs are selling off shares of their companies in record numbers. Like, we know this. So what does that tell you? Like, if you're taking 100% responsibility for yourself and your family and your own wealth creation, your own economy, right, then you're not keeping your money in savings, right? You're maybe borrowing now before prices of borrowing go up. You're probably not keeping hardly any, if any, money at all in the stock market, which is significantly overpriced, and that's a whole nother podcast, all right? But you're taking responsibility, right? So, look, all listeners, we can't really tell you what to do, all right? We can only tell you what we're doing, right? So, Jack, if you wouldn't mind, I know you and I do a lot of things the same. We think a lot alike. I mean, if you were to tell our listeners, what exactly are we doing through this upcoming storm, what would you say are the 2 or 3 most important things you could tell them?
Well, I think cash is going to be king. So you want to have emergency cash and reserves for at least 6 months living expenses. I think that's a no-brainer in any type of situation, economy, good or bad.
Yep.
We're buying very, low-priced rental properties in stable growing cities in the Midwest, priced in the $40,000 to $65,000 range. And, you really, it's going to be very, very difficult in those types of property pricing range for you to, lose 50% of your property value if a market correction should occur, right? I mean,
yeah,
that it'd have to be a World War III or something, just a huge natural disaster for that to even be remote possibility.
Yep.
So, when everything hits the fan, and we know it will, we don't want to take a bloodbath on property values. We want to have cash generating rental income. Even if middle-class Americans are going to lose their homes again, they're going to need a place to live. They're going to need affordable housing. So no matter what happens in the economy, there's always going to be a need and a demand for affordable housing. And as it gets worse, if it gets worse, we have no crystal ball, but it can't keep going on great forever. The music's got to stop here at some point. Then where are they going to go? Where are people going to go to have affordable housing? If you have them, they're coming to you, and you're going to have increased demand, which is only going to protect your investment.
Yeah, I love it, and I want to repeat again that you threw out those numbers, like in the $40,000 to $65,000 range, and I'm repeating it again in case, because I know sometimes listeners hear this and go, "Is that really a real number?" Yes, it's really a real number. And these are nice properties. I mean, they're not brand new. They're not, in the pretty, B+, A- neighborhoods, right? But it's the interesting thing that we found from being in some of those neighborhoods. It's a bit more of an ego stroke to be in those neighborhoods, right? Like look at my pretty property, and you end up with renters that are at a higher priced rent point, and the ROI is absolutely lower every single time. We always end up with the renters that, they're a little bit more educated, they're a little bit harder to keep happy, and they're just much more demanding, and it's much harder to ROI on those properties. So I know you say the words, if the shit hits the fan. I say the words when the shit hits the fan, because I believe it's coming. I mean, we don't have a crystal ball, but I do believe it's coming. And I wonder, there's going to be a pretty big shift in what goes on if it's as big as I think it's going to be. And certainly some of the people that are in our properties may lose their place to live. I mean, that's just the reality of the situation. I don't want that to happen to anybody, but that's certainly the reality. And now the guys that were in the, $1,500, $1,800, $2,500 a month properties, need a $600, $700, $800 a month property to live in. And that's really our bread and butter. And so I get, I want to encourage people that are listening to this, because we've talked a lot about, the instability of what's going on right now. I want to encourage you to put your ego aside a little bit, just for a moment, and think about, where do you really want to be during times of great instability? What makes the most sense for you? Again, we're not here to tell you what to do. We're here to tell you what we're doing and why it makes sense. And honestly, we want to own real property that can't be manipulated by, institutional investors. It can't be manipulated by a broken government. Oh, yeah, they can maybe raise taxes on us a little bit, right? They can maybe raise interest rates, but they can't make our real property become fake property. It can't be manipulated. So we just want to continue to buy things that continue to produce strong, regular, passive income cash flow. That's what we're all about. So anyway, do you have any, that's about all I got, man. That was, I'm a little bit sweaty after all that. I got got a little bit worked up thinking about all this instability. Is there any closing thoughts that you have for us?
I mean, I think we pretty much nailed it. I mean, there's definitely, the future is definitely going to be more and more volatile. We just got to make the best decisions that we possibly can with the information that we have at hand. And for me, I have a primary business, and real estate is a secondary business. And I got into real estate because I wanted to create an additional stream of cash flow, passive income. And that's exactly what it does. And that's the beauty of it.
Yeah.
So you don't want to have right now be relying on one form of income. You want to have diversified forms of income. And we know that property is going to be here 100 years from now. The houses that we're in, they will be here standing 100 years from now. You don't know that about our stocks. You don't know that. You don't know that about our currency. So I think it's it's just a way to protect your family and your financial future.
Yeah, we don't know that about ourselves either.
Right.
So,
exactly.
Anyway, thank you everybody so much. Thank you, Jack, again, for your great insights. And for the listeners, if you got value out of this podcast, please share it. Leave us a review. Thank you very, very much. And of course, I know we talked about some inexpensive stuff in that 40 to 65K range. And if you want to see the exact kinds of properties that we're investing in, just head over to highreturnrealestate.com and simply click on the properties tab. Thank you so much for listening, and we'll see you next time.
Thanks, everybody. Have a great day.